Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a certified financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
What's up, everyone? Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And it's my goal on this show each week to help you discover more when it comes to your finances and your investments and your money, because after all, your money matters. Now, today, I want to talk about what we are seeing really throughout the entire year with regards to the interest rate hikes, the volatility in the markets, supply chain issues, consumer sentiment that we all are feeling collectively around this world that we're living in right now. I've talked a lot about this on the show this year, and it seems like, if we're all honest with each other, there's like no end in sight when it comes to today's market volatility, doesn't it? And it's challenging for many people to keep what I'll call their emotions in check. So how do we do that? You heard me say last week that what we don't do with money matters a lot more than what we do. By the way, if you're 7 years old like my son, he loves it when I say that. Well, this is going to expound even more on that statement. How do we as people, as investors, think about money during a time like 2022? That's my question or a theme for today. And how do you think about money? So I want to talk about the psychology of money today. Look, I'm not a psychologist, nor do I claim to be, but I'm a researcher and an experienced advisor of nearly 20 years. And when it comes to my profession, and we here at One Capital Management are serious about what we do and how we serve our clients. And we've gleaned a lot from many, many years of countless hours and thousands of meetings and with thousands of clients we get to serve across this great country of ours. There's a lot to be said about the emotional and the psyche when it comes to our relationship to money. And a big part of that is looking into the behaviors and thought processes and patterns of our clients and really of you watching or listening right now. So with that, let's get into it. So I've been using the analogy with clients lately, and I don't know where I came across this, so forgive me, but I've been using this analogy around the past 2 years from a monetary or money perspective. We've kind of had a party in a way, again, when it comes to our money, and now we have a hangover. And what I want to share here is that we need to remember that hangovers aren't permanent. They suck, but they're not permanent. So we understand that when closing the world down, I think I made this joke before, we need to remember that if you were to line up a bunch of economists or investment managers, guys like me, if you put us in a room, because of the subjectivity in this world of investing in money, and what we do for clients, we're never always agreeing on the same thing. But this one thing I feel like we would agree on. If you gave us 2 ingredients to concoct inflation at the fastest rate possible, it would be 2 things. And we'd all agree on this, I feel like. It would be shut the world down and print money. We did both things during this monetary party, I'm calling it, over the years of 2020 and 2021. And now we have a hangover and we're dealing with that this year, all of 2022. And I've been talking a lot about it. And we've been seeing it for, like I said, 8 or 9 months. And I think right now, no one has a crystal ball. And as I share, if someone says they do have a crystal ball, by the way, run. We're not out of this. We're going to have volatility. But that doesn't mean you run for the hills. That doesn't mean you go in the corner and cry in the fetal position. That's what I want to talk about today. With money, what you do matters more than what you know or what you think you know. Or said differently, what you do matters less than what you don't do. I like talking about this because it helps us relate, what our eyes are seeing, what our brain is interpreting, and what our heart is feeling. Because that's what we're dealing with pretty much every day with all the data inputs we have on a daily basis of all the things we have to deal with, good and bad. We also do that with our money. And even the smartest, most well-informed savers out there, or retirement savers, or anyone out there who's investing and saving, can lose money, a boatload of money, if they don't have their heads on straight. So just because you think you're in retirement right now, or maybe you're building up your portfolios right now and you're having some volatility and you're losing money, you're doing something wrong. That has nothing to do with having intellect or not having intellect when it comes to money. There's a book that I want to reference and then I love, and in fact, I have it right back there. The book's called The Psychology of Money. And there was an interview with the author who actually revealed some very interesting insights onto how to build and maintain wealth. So I'm going to tie in the psychology of money, the emotions that we've been feeling this year with volatility, with how to build wealth still and also keep it. Because a part of the keeping it has to do with, hey, Brad, I'm 50 years old now and I'm watching this and this volatility is freaking me out. I'm losing all that I've gained. Because in volatile times like this, we have to remember these things. So a little over a week ago, we saw yet another federal rate hike, which again was warranted of 75 basis points. Now, what people are realizing in the equity market just gives you some context here for a second. This year to date, some data points I want to bring up as we go into some of these emotional psychology of what we need to be looking at here in this year. Here's some stats I think are interesting. As of the close of that week, a week ago, the Dow was down 17%. The S&P was down 21.6%. The NASDAQ, which comprises mostly tech environments and companies, down 30%, hit the hardest. Foreign stocks were off 25%. Emerging markets were off 24%. Now, another context for a quick second, the top 3 sectors of the S&P 500, there were ones that were positive, were energy, utilities, and consumer staples. Now, energy, by the way, just to give you a quick reference point so far this year, was up 32.3% to date. One of the things that we did here at One Capital Management, real quickly to speak about portfolio management, coming off of last year, heading into 2022, we were actually heavy energy and light technology. And we did that on purpose. We didn't have a crystal ball, but that's part of protecting your assets. A good portfolio manager will also protect your assets. And that's what we were doing, which is why the numbers I just shared with you, for any clients listening right now who are watching, are not likely down those numbers. Now, I mentioned the top 3 sectors. Let's go to the bottom 3 for a second. In the bottom 3 sectors of the S&P 500 were communication services, information technology, basically tech and consumer discretionary, and basically things that aren't necessary, if you will. Those were down the most. Consumer services, real quickly, was down 37%. Consumer discretionary, 28% down. All right. So giving some context of all the things that are up, everyone thinks everything is down. Look, energy obviously is up and utilities are up because of inflation and because they're staples. They're kind of the necessities. That is a normal recession type of environment we are seeing. Now, there's also a great article that I'm referencing today in Kippenshire by a guy named Taylor Schulte, who's another CFP, together with the items I want to bring up with this interview I saw as well, that was done again by the author of The Psychology of Money. And as an advisor and as a podcast host, as a YouTube host, as a radio host, I regularly engage with a lot of, I guess you'd call them money experts. I think for everyone listening right now, in my world daily, that's what we're involved with. And I've interviewed everyone around the sun, from hedge fund managers to CEOs of companies, clients, and we get to talk a lot about things. And I've gained incredible insights from all of these conversations. Is why I want to do this show and share that with everybody. And I want to share simply one thing to say is this. This interview that was actually on the Stay Wealthy Retirement Show, it taught me that all financial education in the world, and I've always kind of known this at my core, but all financial education in the world doesn't matter if your actions don't align. All education, by the way, not just financial education, okay? If discipline isn't involved or actions don't align, it doesn't matter. I want to say that again. All the financial education in the world that you might have or want to obtain doesn't matter if your actions don't align with that knowledge or education. And the conversation I'm referencing here is again with Morgan Housel. He's the author of The Psychology of Money. And in this book, he aims to explain why how we act matters more than what we know. And listening to his words and reading this book, I've read it a couple times, I came to the realization that what he says about the psychology of money is absolutely true. I think it's important to reiterate this point I'm making here, because we're heading out of summer, out of the dog days of summer, and we're in the 4th quarter now, which I don't know about you, I cannot believe it. I mean, I don't know, my wife, and again, I don't know about you guys, but she's already got our Halloween decorations up, heading into Thanksgiving, all the stuff setting up right now. But the same philosophy applies to other aspects of our lives, like our health and our habits, the philosophy being the psychology of money. The psychology of money is actually a very simple principle. When there are people out there in the world who have no financial training, no financial education, no experience with money, again, this is from Housel, yet they manage to do quite well. Why? Many, in fact, manage to morph into what we now know as a term, the millionaire next door. They live very simply, and this is how I want to share this. I actually shared this on an episode, a show a couple weeks ago on the Gronkowski episode. He really understood this, and he basically subbed out the flashy for the basic. And I know a lot of us get caught up in it. I understand. I'm a part of this too. I'm not, immune to this. But I think it's important to reiterate this kind of psychology of money, because right now, I think more than ever is a great time to truly take stock in this and realize that investing right now, we're continuing to invest, understanding what your time horizon might be. It might be longer than you think. And really, you want to find good management to find good values that might be a better place to place your money than buying that extra pair of Nike shoes for $120. And Housel, the author of Psychology of Money, also says the opposite is true. I mean, there are Harvard MBAs and partners at places like Goldman Sachs who fail during the best financial markets and go bankrupt all the time. And you may think, well, why is that? How can that be? And I want to share that story real quickly and take a pause for a second, that just because you may not be a Harvard MBA, or just because you don't work for Goldman Sachs or some investment bank, doesn't mean you can't be successful with your money. I've shared this with the thousands of clients in 19 years of doing this, that discipline and discernment, the 2 Ds I always bring up, matter more than the knowledge of some price to earnings multiple or some ratio that you might bring up. And again, Housel, he insists that this is where the psychology of money comes into play. And I agree. What matters with finances and investing is how you behave. It's not what you know. I want to share that again. Investing, the true successful, matters more in how you behave, not in what you know. Which is why I always believe that having an advisor, I always get back to that, I understand this, but having an advisor or anyone in your life that has a skill set that you don't have or you don't possess or want to have, makes sense to have that person in your life. It just logically makes sense to me. Proverbs, the book of Proverbs and the Bible, Proverbs 15:22 talks about this. It says, those who are successful have many advisors. And let me ask a few questions here to give you an example and frame this up. Can you control your relationship with greed and fear? If not, then it doesn't really matter how many hours you spend studying finance at Yale, right? I mean, without a handle on your emotions, which is something I talk about heavily here in investing and as an advisor, you might be the type of person who sells all their investments on maybe March 16th, 2020, when the Dow Jones Industrial fell a record 2,997 points that day. Separate question, dovetailing off that, can you plan for the long term and stay the course? This goes to my philosophy of discipline and discernment. If not, then you could have made any number of tragic mistakes in a year like 2020, which is I know a couple of years ago, or right now in 2022, and you may have no idea what steps to take next. In the meantime, a long-term disciplined investor who has a handle on their emotions and a long-term investing plan, something we talk about here at One Capital, may have done nothing during the beginning of the stock market tumble in 2020, which obviously came back, or even right now in 2022. And sometimes the most disciplined investors may have even invested more or dollar cost average during the market's darkest days throughout this year, 2022. And you can see where I'm going with this. Again, I want to reiterate, my 7-year-old Brooks loves when I say this, but what you don't do with money matters almost more than what you do. These things that I'm bringing up cannot be taught in an academic setting. Housel, the author of The Psychology of Money, went on to say, this is the quote unquote soft behavioral side of investing. It has little to do with numbers or math or any numerical data, and much more to do with someone's temperament and ability to just stay the course. Friends, I'm sharing this largely because this book, by the way, great book, if you ever want to read it, The Psychology of Money by Morgan Housel. But I'm sharing this because I can give you economic data to back this up. I can give you all the inflation numbers we've been going through the past couple weeks on the Make Your Money Matter show. But I thought I want to kind of go back up to the top part here and talk about the psychology, the rational, the logical, and then the connection point between that and our hearts. And really, let's call it our second brain, our stomachs, and our emotions, what my kids call their tum-tum. Right now is a great time to talk about it. That's why I want to dedicate this week's show to this. No one has the answer to what's going on right now or what's going to happen next, us included. Now, we're also not saying that it's time to run for the hills either. This is the draconian effect that many people get involved with and where we're all dead and doomed, okay? But we also, again, on that note, we don't have this crystal ball either. And what we are seeing is good fundamental areas and numbers to invest in. Again, those numbers I brought up earlier, there are areas to invest in that are overweight. Let's say things like energy, like utilities, things that you know are somewhat more recession proof, or might win out based on historical data. Now, the other side of the things, the three worst sectors I brought up earlier that have been hit the hardest, there's some companies and some sectors and industries in there that are just going to be down because of consumer sentiment and not necessarily down because of the fundamentals of that company or that sector or that industry. So real quickly, just as investment managers for our clients, we want to find those areas, but we can't do that if we have clients that are completely, distraught, running to the corner, again, like in the fetal position, saying this is the end. And I want to share something for any clients listening right now here at One Capital Management. This is to your credit. We haven't had a whole lot of conversations with clients that are fearful. They're kind of like, hey, the plan's in check, we're good, and we appreciate that. What are you seeing right now? That's a healthy conversation to have, and you want to make sure you have that with your advisor. We appreciate that trust. We do not take that for granted by any means. And it shows us that, again, to me, as a seasoned advisor, it shows us that planning wins out. Those watching and listening right now, and that's why we want to do this show around planning, kind of bring things back up there, the emotions kind of run check. We get kind of wild on our emotions. Like, when you're a kid and your parents say, follow your passion. And I've always said, and I've spoken on this before at dinner events and on my radio show, I don't know that that's the word we should be using. Because if you look up passion in the dictionary, it's an emotion. When's the last time you really want to make sound, especially financial decisions, on your emotions? You want to find purpose. So I want to change the word from passion to purpose. Follow your purpose. And I think you need to be aligned. You need to pray on those kind of things. Find that purpose for your life. And when it comes to your money, again, attaching a goal and working towards that goal matters. It's the psychology of the discipline that keeps it going. And the knowledge that we talk about through the years of our clients, of us working together, we have a plan in place and we partnered with them to do that. And we see that. I think it's really big because there's a big kudos I want to give to our clients. I have other investment advisor friends who I know and colleagues who are on the phone 9 hours a day because basically they're handling client emotional calls. And they're kind of almost lamenting in a way. And I'm like, your job as an advisor is to make sure you steward them in the right direction and they trust the plan that you guys are on. And so I look at that and say, we're doing something right. And those that are following this are doing that too. And that's what I want to share. Why having a plan matters more than ever. Again, I know you're probably rolling your eyes when I say this if you watch the show every week, but it's interesting to note, you can be the best stock picker in the world. And again, Housel said this, but here's this quote: if you lose your head, none of it matters. So the lesson around why having a plan matters is to control and manage the emotions every day, every minute, every hour. We have emotional stuff that sets us off, good and bad, that we can react to. And the lesson right now about having a plan may even be more crucial right now, considering the uncertainty of what we're dealing with in this year. No different than the uncertainty we've been handling for the past couple of years. I mean, when this subject comes up, I find that so many knowledgeable and informed investors or people out there in the world are rightfully perplexed by how the stock market has behaved. I mean, you hear these technical analysis junkies out there talking about, support level at this number, and it's all, to my world, technical jargon. The reality is the market is made up of you and I. So consumer sentiment nowadays, to their technical numbers, is a large part of that because we have emotions going into it. If the market's made up of human beings and human beings carry emotions, guess what? It's an emotional market. But it's also the companies and the sectors and the industries that make up the market that we get to invest in, that we are investing in. And on the equity side, when there's growth and value, there's value to be made. And the fixed income side, bonds, whether that's government bonds or corporate bonds or municipalities, it all works together. And how we interact with those and how we build the portfolio around that matters. It matters for the plan and ultimately for the success of your investing life, of your retirement life, whatever it is you're trying to attach a goal to when it comes to your money.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Morgan Housel actually brought this up too in this interview I'm mentioning here. And this is where you have to realize that the stock market, and I want to share this because I think it needs to be reminded for people. The stock market is not the economy. I want to share that again. The stock market and the economy are not the same thing. The growth, here's an example. The growth of technology has made the disconnect between small business and major tech companies wider than ever. I mean, as an example, so Yes, thousands of restaurants, like we saw 2 years ago, may have been closed or operating at limited capacity for months. And there's some industries, things like travel, hospitality, that have been hit harder than most, like we've seen. But the flip side of that is the tech sector, which actually excelled dramatically in these lockdown periods. Amazon's a great example. I looked up a stat here. In July of 2020, Amazon shipped 490 million packages in the United States in March of 2020. Now, going back a couple years when everything was falling apart. And again, Housel brought this up, saying nearly everyone was in absolute shock. But now it's almost as if someone snapped their fingers and we're nearly back to all-time highs, like we saw. And then we see the seesaw that's been happening this year. Now, some of that was the jobs and tax cuts from 2017, the Trump tax cuts, leading into the pandemic like we saw. It was also understanding that the economy, and this is gonna sound like a really aha moment right here, but the economy is big. I know that's like an aha statement, like this guy's really smart. It's huge. But when we focus, like the media really loved to focus on this one area, hospitality and travel, and we thought the world was shutting down when like 80% of the rest of the world was thriving. Technology was booming. We were still going, money was, and we have a problem now with it, but money was just everywhere. And we need to make sure that we're filtering what we're reading and intaking, what our eyes are seeing, what our brain is rationalizing and interpreting, and ultimately what our heart is feeling. And we need to make sure we're operating not from our heart, which I know sounds a little crazy. We want to operate from a logical and rational perspective when it comes to your money. You know, when we look at everything that happened in the past couple of years and even into this year, 2022, and we're focusing on certain areas, but not the entirety of everything, we as investment managers have to look at the whole piece. For example, again, going back 2 years, again, 2020, most people were focusing on restaurants and hospitality. Those were big ones. They were hit the hardest, and there's a lot of people that worked there that were really affected. It was devastating, don't get me wrong. But again, there was a whole vast other area of the market that was just popping off. Again, technology being a big one. You know, we're ordering things, consumer staples, utilities were still up, energy was still, you have this broad market. And so this again is why you have to have a plan to stick to what's going on and not get, too disrupted by news reports and these 140 character tweets that we're thinking like that's the gospel all of a sudden. What we're seeing right now in volatility may have been impossible to predict, although I think looking into the past 2 years, back to my comment, when you do all these things, it's kind of, it's gonna happen. Again, if you shut the world down, inflation's gonna happen. You're gonna have inflation, but those who had a plan and follow it are going to be doing well when all this is through. And Housel, again, went on to say something that I thought was very interesting. He said it's impossible not to be emotional about your kids, as an example, specifically, or your money. Interestingly enough, for parents and grandparents out there, he related from a psychologist's perspective, kids and money. It's interesting as parents, I'm a parent, and he's right about your kids and your money and being in touch with your emotions. That's all good, but your financial planning, your ability to follow it are what will keep you on track while helping you avoid the emotional investing decision based on things like fear or greed, which are not great. Now, I mentioned last week before, I can't remember, I mentioned the Warren Buffett quote, which I love. And I think it's a good thing to remember here as we talk about the psychology and what's going on in the volatility of 2022. Be fearful when people are greedy and greedy when people are fearful. It's an interesting note to take right now. Now, I made a comment a little earlier about obtaining wealth and then staying wealthy. Now, the difference between getting wealthy and staying wealthy, the difference between amassing that wealth over time and actually keeping it is something that the Psychology of Money, the book that Morgan Housel wrote, points out. There's a difference between knowing how to get wealthy and knowing how to stay that way. Now, this is interesting for those that are maybe mid-year career right now or starting your career, or maybe even, by the way, it's also related to those that are in retirement or getting there, the idea of building this wealth, and then how do I actually keep it? And this book talks about a great story of a guy named Jesse Livermore, who is probably known as one of the greatest short-term investors of all time. Great story. Livermore made a name for himself as one of the most successful stock traders of the 1910s and 1920s. And up until shortly after the Great Depression began in 1929, when the worst day of the Great Depression hit, Livermore revealed that he had actually shorted the stock market and made the equivalent, get this, equivalent today of $3 billion in a single day. Now, unfortunately, Livermore didn't know how to set boundaries or plan for the worst of times. He kept investing more and risking and taking on more and more risk. And there's a difference here between investing more and taking on more risk. But while he was doing all that, he eventually went broke and sadly committed suicide. Now, Livermore's story is tragic. But Housel, when his interview was talking about this, it goes to show that getting rich and staying rich are two entirely different skill sets. That's the moral of this. Now, I want to be very clear when I talk about rich and wealthy. You don't have to attach a B behind that number, okay? I don't care if it's $500,000, $1 million, or a guy like Livermore who amassed $1 billion or $3 billion in a day and lost it all. It's all in context, right? What I'm saying is when you amass wealth over 10, 15, 20, 30 years, maybe you have a couple $100,000, $1 million, what matters is the question is how do you keep it? And right now, 2022, I think for those that are maybe nearing retirement or maybe becoming financially free, maybe sold a business in your 30s or 40s, whatever it is, those emotions are kicking up in your mind right now. I mean, for example, Livermore, he knew how to pick stocks and anticipate maybe big market swings, but he had no idea how to hold on to it. He had no idea how to hold on to what he had earned. That's another trait, another skill set entirely. Now, according to Housel, people who want to build long-term wealth need to learn how to nurture those skills separately. So I agree with this. Getting rich requires some optimism and some skills. And he went on to say, but staying rich requires pessimism. So said differently, amassing wealth, you define wealth for yourself, over your career takes hard work. It takes optimism or the glass half full mentality of going to work, seeing things for what they are, but also knowing that God has a plan greater than what we're dealing with right here, right now, and having a skill and a trade in what you're doing, which all of you watching or listening hopefully have, but understanding when you get to that retirement. And by the way, I've said this before, retirement can be becoming financially free. It doesn't mean it to be 65. It could be in your 30s or 40s if you start a business or you live enough what you want. That's great. But once you get there, once you stop working, it doesn't mean your purpose stops. Your purpose for life is much more than just being, an engineer or a doctor or a business owner or whatever it is. It's more than that. And it's also taking an idea of working with some to have, an eyebrow raised into some of the things you should or should not be investing in. That's the old adage of you're supposed to get, more conservative or aggressive depending on your age. And it's really, neither one is right or wrong. It's just what works for you and your family and as you build that plan with your advisor. Now, ultimately, that's what Housel himself sometimes goes against the grain when it comes to traditional financial advice, which I kind of like. I definitely think outside the box here for our clients. This award-winning financial writer, Housel, I'm mentioning, he actually paid off his mortgage recently. He mentioned this, even though it made this is his words, no mathematical sense. I mean, you can get a 30-year loan at his rate where he was paying at 2.9. That is not the case right now. But he felt confident that the stock market will return more than that over time. But to him, he says, just not trying to score the best investment returns, but he's also trying to sleep at night. And so when you think about these, when I talk about emotions and I talk about rate of returns and volatility, they need to go hand in hand, but the rational logical should be the one driving the ship, not the emotions. So in the crazy economy we're in right now, I think freedom and security are worth their weight in gold. Then how do you get there? I think is by understanding that time matters. So looking at a day's stock market, or the volatility of a week or a month or even this whole year, it's short term in the grander scheme of things. And I know right now this year has been hard because look, I think I shared it last week, in the past 14, 15 years, we've been somewhat spoiled. Low interest rates, good market returns. We've come off the recession of 2008, really, and pretty much had a 14, 15-year bull run if you look at the numbers. And we haven't seen this kind of volatility like this, but it's systemic. It's normal. It's cyclical. This is a normal cycle of markets. And again, given what we did the past 2 years, to my analogy earlier, we've had somewhat of a monetary party, and now we're having a fiscal hangover, if you will. The good thing about a hangover, it's not permanent, all right? And so I think it's important as we look all of this into context and relating it to our emotions and the psychology of how we look at money. Now, before we go, if you found anything helpful today and want to learn more, you can visit our website at onecapital.com. You can also call or text us. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, as I always say, we value relationships. It's the lifeblood of what we do. So click, call, or text us today. If you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. And as I say every week, if you enjoy the show, if you like the show, share it with someone you like. I guess if you don't like the show, share it with someone you don't like. But until next week, always remember, make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.